Hi, John Dobush from Forbes here at the Money Show San Francisco. Welcome to everybody on Facebook Live. Here with Mike Larson from Weiss Ratings. Mike, what's the name of the newsletter you do at Weiss?
High yield investing.
High yield investing. I totally love that. I'm the Forbes dividend investor guy, so I'm going through the same process you are a lot. I'm looking at companies and trying to find out if the yield's sustainable and is it rising, is it high. So you do a lot of things there, right? So Weiss started out doing ratings of insurance companies and banks?
Yeah, that's right. The rating side of the business has been since 1989 looking at safety ratings for banks and insurance companies. And then more recently in the 1990s, we started to get into the stocks rating business as well. So we rate stocks, ETFs, mutual funds, and it's a quantitative-based model that looks at a number of different factors, and then uses that to provide letter grades for individual investors. So every stock, every ETF, every mutual fund gets an A through E rating, and it helps people know which companies, which stocks are fundamentally stronger, and which have the higher potential for gains.
Okay. Yeah, Martin Weiss has really built out a huge empire of newsletters and everything, right? So you're the editor of a newsletter focused on high yield bonds, high yield investing?
High yield investing. So it's it's not just bond ETFs, for example. It's also dividend paying stocks. We hear constantly from our investors, I need yield, I need income.
Yeah.
And, CDs are paying 1%, 10-year treasuries paying 2%, give or take. I mean, nobody can live off that. You can't retire off that if you're still working.
Well, if you have about 10 million and you
there you go.
you eat great value branded foods, but yeah.
If you live in Massachusetts and you just got that winning Powerball ticket, you're all
lady's set. Right.
Yes, she is. But for everybody else out there,
it's tough, right.
Yeah,
so is it a mix then of a third of dividends, paying stocks, REITs, MLPs, high yield bonds? How do you mix it up?
Yeah, those are the kinds of investments that we're involved with. I mean, basically what we do, we did some back testing on a model based on the ratings, a system that spits out 15 potential candidates for the main portfolio every month. And then it's my job to look at this list. Every company's got to have anywhere between 1 times the dividend of the S&P on up to 4 times. It's got to have 10% annualized dividend growth the last 3 years. It has to be either a hold or buy rated stock, and it has to meet a few other tests that we
10% over the past 3 years.
Yes, 10% annually over the past 3 years.
Annually?
Yes, it has to have grown dividends at
That's got to be a very small number, right?
No, believe it or not, there's a lot of companies out there. I mean, one, I'll just spill the beans here, is Texas Instruments. I mean, obviously their earnings have been fantastic. The chip business has been going very well. That company pays an above market dividend, and it's grown that dividend at a 17% rate over the last 3 years.
Right. Okay.
Annually over the last 3 years.
Right.
So
okay.
There's a lot of names that you'd be surprised that, but you can find that yield, you can find that reliable yield. It can really help your portfolio.
So you've got to have a yield greater than the S&P 500's overall yield, which is like
1.9, give or take.
Right?
Yeah. So we're looking at least that on up to 4 times that. And some of the companies, obviously the higher the yield, the more risk you're taking on, but they still pass our tests for dividend sustainability. We look at free cash flow, earnings, and whether or not these companies can actually.
You're speaking my language here. I do the Forbes dividend investor, so I wrestle with these questions every week too.
Sure.
So you, in terms of sustainability of the dividend, do you look at the dividend divided by cash flow, free cash flow, operating cash flow? Is there some way that you learn to trust?
Yeah, it's a free cash flow and an earnings base. It's basically 2 tests that we give it. So we've got those for dividend sustainability. Again, we've got dividend growth we're looking for. We've got the Weiss rating, which starts the whole process out. So you're getting some analysis there of the underlying fundamentals. And the companies we have in there, they're a mix of anywhere from, like I said, sort of Texas Instruments 2-ish yield on up to 8, almost 9% for a couple of the candidates. So.
Do you have anything from the retail sector?
Retail, it's funny. Of the overall market, I'm still bullish on the outlook. I like where we are in terms of the interest rate cycle. Interest rates haven't gone up enough to really fight for the economy or for the markets. The economy is not going gangbusters, but it's doing okay. And so in this environment, it's really, that part of it's doing well. But there's a few sectors, retail and autos, for example, that I'm just staying away from. I think they're value traps. I think you get this sort of Amazoning of the retail space that's going on. So there's not a lot of, on the dividend front, there's not a lot of these companies that pay very nice yields. So there's nothing much in either autos or retail that we're focused on. A lot of it is, so that we've got some REITs, like you said. We have a couple of energy plays. We've got some, there's an industrial company or two, technology, just places like that I think are going to be better performing industries.
I don't know about the financial health. I mean, I do know about the financial health. It's not looking too great right now in terms of sales. And we'll wrap this up in a second. I know we're getting a signal here, but like Kohl's, I mean, you're getting a 4-point-something% dividend yield there. Abercrombie, well, not so much them. AEO, American Eagle Outfitters, DSW recently was above a 5% yield. So you do have some fat dividend yielders, but it's that but fear that the monster from Seattle, Washington.
Exactly, and I think at some point, the markets are going to just kind of come to terms with that. I mean, Amazon is not going to get every last sales dollar in the world. There is a big American consumer universe out there to spend, but I'm waiting to see if the stocks start bottoming out and show some more encouraging technical action before looking at that sector versus some other more promising things.
We have a lot we could talk about. We probably will. So let's cut this one and we'll go to another one.